Let's start. So the third function is about the financial system. The central bank would have to supervise or manage the financial system. Now, we all know from year one economics, the central bank is called the lender of the last resort. In other words, when all the commercial banks, they cannot borrow money from anyone, they can always turn to the central bank to borrow. Now, why is that the case? Why the central bank is the lender of the last resort? That means the commercial banks can always turn to the central bank to borrow as the last help they can get. To understand that, we need to understand the check clearing process. Because the check clearing process related to the liquidity of these banks. So now, let's look at an example to see how checks are being cleared in Canada. Checks being cleared under what we call the Canadian Payments Association, CPA. In the past, this system is actually operated by chartered banks. So before 1990s, anyone who wanted to issue checks to their customers, if they were not a charter bank, they must affiliate themselves with a charter bank so that they can have their checks cleared through the charter bank affiliation. And that gave the charter bank monopoly power. Over checks and checking deposits. Because only the charter banks, they could clear checks. So anyone who wants to use check, they have to go open a checking account with the charter bank. So that is like cheap, low-cost funding for the charter bank when they have the monopoly power to issue checks and clear checks. So now, since the early 1990s, this is now being under the control of the central bank. Let's see how the checks are being cleared in Canada. For example, if this is you want to pay tuition to U of T, and you write a check, $10,000 to pay tuition, and you bank with the Royal Bank of Canada, but U of T bank with the Bank of Nova Scotia. So how this check is being cleared when you and U of T are banking with different banks? So now, the RBC, the Bank of Nova Scotia, and the Bank of Canada. So 3 sets of T accounts, something you learn in year 1. And now, first, all check issuing institutions must hold balance at the Bank of Canada settlement account. In terms of deposits. The reason we call this settlement account because they use this account to clear checks among themselves between different banks, for example. So, since this is deposit at the Bank of Canada, therefore, the settlement account is on the liability side of the Bank of Canada T account, the balance sheet. So, we have RBC, we have Bank of Nova Scotia. So now, when U of T receives your $10,000 check, U of T will deposit. So its account will go up by $10,000. So now, Bank of Nova Scotia receiving the check that U of T deposit, and that check is from RBC, and therefore, Bank of Nova Scotia will ask RBC to transfer $10,000 to clear the check. So $10,000 will be transferred from the RBC settlement account to the Bank of Nova Scotia settlement account at the Bank of Canada. And when this happens, the reserves for Bank of Nova Scotia will go up by $10,000 because Bank of Nova Scotia has received $10,000 and the settlement account belongs to the reserves, because the reason why banks hold reserves on their deposit is for depositor withdrawals. People can withdraw their deposit at the ATM machines, or they can withdraw the deposit writing a check. That's why the reserves serving the depositor withdrawal request. This part is to clear checks that is related to the settlement account. So now, Bank of Nova Scotia receiving $10,000 from RBC, then Bank of Nova Scotia will let U of T have $10,000 to use. On the other hand, your deposit account at RBC will drop by $10,000 because RBC has lost reserves of $10,000 because of this payment. So this is how the check is being cleared. When the people who issue the check and the people who receive the check, they are banking with different banks. And now, knowing this, we have to go to the banking operation, something we talked about earlier in this course. For a typical commercial bank, deposit rate and the loan interest rate, the difference we call the spread. So for example, if a commercial bank paying 1% on deposit and charging 4% on the loan interest, therefore the spread is 3%. This is like the profit margin. And now, for the central bank, the Bank of Canada. So So the Bank of Canada takes deposits, like the settlement account deposit rate. So commercial banks, they need to deposit money at the settlement account so that they can clear their checks. At the same time, we have the bank rates. Bank rate is a loan interest rate when commercial banks borrow money from the central bank. So the bank rate is the interest rate on loans when commercial banks borrow money from the central bank. And this gap is actually by law set at 0.5%. This gap is fixed. It's what we call the operating bandwidth. Which is equivalent to the spread of commercial banks that we looked at earlier. And now, the spread of commercial banks are typically much bigger than the operating bandwidth set at 0.5%. And you may consider these two same in nature, that is, the profit margin. So why the central bank profit margin by law is set at only 0.5%? Because the central bank is not profit oriented. The central bank is there to facilitate liquidity for commercial banks. It is not aimed to make a profit. And that's why 0.5% seems to be adequate to pay for the daily operating expenses for the central bank. And that's why it set that gap, the operating bandwidth, at 0.5%. And now, we understand this bandwidth. So now let's look at this example. 0.5% bandwidth. The deposit rate on settlement accounts and the bank rate, always 0.5% gap. Now suppose the bank rate at this moment is 2%, then the deposit rate for the settlement account must be 1.5%. And going back to our example, what if RBC does not have enough balance in its settlement account to clear the checks? So suppose RBC does not have enough balance in the settlement account to clear the checks. What can it do? It has two choices. First, it can borrow from the central bank at 2%. So, if borrow from the Bank of Canada it is 2%. The other option is to borrow from other commercial banks. Through the interbank overnight rate. IBOR, the interbank overnight rate. This is the interest rate that commercial banks lending and borrowing between each other. And typically, it is just for overnight. Because tomorrow, RBC may have a surplus of balance in the settlement account and pay back the loan. Therefore, they only borrow overnight. And now, imagine if TD has surplus in its settlement account deposit balance. Would TD be willing to lend money to RBC? The answer is yes. If TD can earn 1.75%. So compared to leaving the money in the settlement account, TD will only earn 1.5%. And if TD lend money to RBC in the overnight market at the IBOR, it can earn 1.75%. That is, TD can earn 0.25% more by lending in the overnight market to RBC. And RBC also wants to engage in the interbank overnight market because RBC pays less. That is 0.25% less. Because borrowing from the central bank, the bank rate is 2%. But borrowing in the overnight market, 1.75%. So now, for this reason, the interbank overnight market, most of the time, it is actually right in the middle. So the interbank overnight rate, most of the time, is right in the middle, 1.75%. So now, from this explanation, you understand why banks would always prefer to borrow from each other before they turn to the central bank, because they can save more if they borrow from each other rather than borrowing from the central bank. So this is one reason why the central bank is the lender of the last resort. Banks always try to turn to each other to borrow before they borrow from the central bank. And now, it brings us to the next function of the central bank: monetary policy. So monetary policy, the instrument will be the interest rate. So, when the Bank of Canada increasing the bank rate, Remember this? 1.5% and the bank rates 2% for this operating bank. The gap of 0.5%, and IBOR is right in the middle, 1.75%. So this is the bank rate. So if the Bank of Canada raising the bank rate by, let's say, 1%, therefore the bank rate is now 3%. And this deposit rate on the settlement account, 2.5%. And then IBOR will become 2.75%. And why changing the bank rate will affect all the interest rates in the economy? Because first, IBOR is the lowest cost of funding for banks. Now, even though bank deposit rates to depositors often less than IBOR. But why IBOR is considered to be the lowest cost of funding rather than the deposit rates? The reason is the deposit rates to depositors. On top of that, you have to add the services. To service the depositors, banks, they would have to set up branches. That's why every corner in the neighborhood, you see a bank there. They have to provide convenience to depositors. And having branches, they would have to rent a place, hire employees, and provide services like deposit ATM machines. And that costs the banks money. When we add these two together, the total cost of deposits will be higher than borrowing from each bank, from among each other, the IBOR. So, in our example, when the central bank raising interest rates, the bank rates will go up, IBOR will go up, then all deposit rates and loan rates will go up because this window is moving up. As this window moving up, the IBOR will go up and the cost of funding for banks go up, the deposit rate will go up, the loan interest rate will also go up. Therefore, all the interest rates in the economy will move in the same direction as the movement in the bank rate. And this is the reason why people call the bank rate is the mother of all interest rates. Because when the central bank changing the bank rate, all the interest rate in the economy will be moving in the same direction. So now, this is one instrument to conduct monetary policy by changing the interest rate. But changing the bank rates may not be enough. They need to go with the open market operations. In other words, to support the increase in the interest rate, money supply must drop. So in order to reduce money supply, the central bank will sell government bonds to the public. When the central bank sells government bonds to the public pays the central bank through their checking account. Therefore, M1 plus will drop, money supply will drop. So the open market operations can support the bank rate movement by changing the money supply. And now, next, political business cycles. In other words, the business cycle initiated by the political process or the political system. First, electoral business cycle. In other words, before election, political parties, they all have the same trick. They increase government spending, lowering taxes. Now, in Ontario, we are going to have an election in June. So if you look at what Doug Ford has been saying in the last 2 months, more spending, less tax. Single trick, because this would increase outputs, lower unemployment rates. And that will help them win votes. Now the politicians, they have only one objective, is to win election. This is their livelihood. If they do not win election, they will lose their jobs. And by doing this, there is always expansionary bias. When it comes to election, in order to make people happy, to win votes, they have to boost outputs, lower unemployment rate. And that trigger an upswing, booming economy. The other type of business cycle, because of political system, is the partisan business cycle, which is based on political ideology. For example, for conservatives, they are always about cuts. For the liberals, they're always about spends. So if you look at Doug Ford, when he won the election, the first thing that he did was to cut a lot of benefits, cutting the government expenditure, raising taxes. Look at Justin Trudeau. After he won the election, it's always about spending, spending, and spending. That means this is contractionary. This is expansionary. So when different political parties come into power, they will have different implications about our business cycle. Conservatives take power, we expect to have contractionary impact on the economy. When the liberals take power, we expect to have expansionary in our economic output. And now, why this is important? Because it goes into the debate whether the central bank should be independent from political influence. First, the central bank is the most influential institution in the economy. The monetary policy affects everyone. When we have more money in the system, everyone would have more money. When we have high interest rates, everyone who borrows and saves would be affected by the change in the interest rate. And therefore, the central bank monetary policy will touch on the life of everyone. That's why it's most influential. Some people said, yes, the Bank of Canada should be independent from political influence. The reason is politicians only care about winning elections. In other words, the electoral business cycle. They don't care whether the economy is overheated or not. They just want to win election. Even though we are already overheated, when they come to election, they always want to further overheating the economy so that they can win the election. And therefore, we cannot trust the most influential institution in the hands of the politicians because their own agenda, winning election, is not going to be concerning about the healthiness of the economy. That's why the central bank should be independent of the political influence so that the central bank can focus on doing what is good for the economy, not to serve the political purpose of different political parties. On the other hand, people say no, the central bank should not be independent. Bank of Canada should not be independent because the most influential institution must have elected officials to oversee its operations. In other words, accountability, transparency. This is the most influential institution. We cannot let it run on its own. It must be accountable to someone, at least to the Canadians. And in order to make it accountable, we need to have elected officials in the bank. Because elected officials are accountable to the voters. If they're not doing a good job, they won't get re-elected. And that's why people argue the central bank should not be independent. But if these are the two concerns, then we can solve it very easily. We can still be independent by disclosing information. That is, having the governor going to the parliament to express his view about the economy, what monetary policy is likely to be implemented in the near future, and what the bank has done to provide this information to the public. It will make the central bank accountable to the people. At the same time, be transparent to the people without political influence. So this is like the best of both worlds. Independent from political influence, at the same time, be accountable and transparent to the public. But it brings out the issue of gold independence. That means the central bank can choose its goal without influences from fiscal authorities. That means the central bank can choose what it wants to achieve without any input or influences from the fiscal authority, like the governments. On the other hand, we have another measure, the instrument independence. That is, the central bank can choose how to reach its goals without influences from fiscal policy or authorities. Now, in Canada, we don't have gold independence because the mandate is set. Inflation between 1 to 3%. That is the mandate for the central bank. The central bank cannot choose its goals. That is, the central bank cannot say, now I want the inflation to be between 2 and 5%. It's not possible because it is set in stone. The inflation the central bank wants to keep between 1 and 3%. But the central bank can achieve this goal using whichever means it thinks is appropriate. That is, it can use the monetary policy, open market operations, or changing the bank rate. It can do whatever it wants in order to make the inflation in Canada between 1 and 3%. Now, in Canada, Bank of Canada has this, what we call joint responsibility. The governor and the finance minister they should work together. That is, they should have very close contact with each other to have consensus on its policy. But If these two do not get along, in other words, if the central bank wants to raise the interest rate, the finance minister wants to lower the interest rate. If they have different opinions, then the finance minister can issue a directive telling the government what to do and for how long. In other words, this special superior power to the finance minister overrides the governor's independent thinking. Now, this rarely happens because the finance minister is a politician. It is not a technician. It doesn't know much, or it is not as knowledgeable as the governor of the Bank of Canada in terms of banking and monetary policy. So most of the time, the finance minister would agree what the governor suggests. It rarely comes into conflict between the two. What about our neighbor, the Federal Reserve? Federal Reserve is actually the central bank for the US. And now, Federal Reserve is a different system compared to Bank of Canada, because in the US, there are 12 Federal Reserve Bank districts. Like Boston, Chicago, San Francisco, New York, we have 12 different Federal Reserve districts. And nationally chartered commercial banks, they buy shares in their own district, which pay them 6% dividends. At the same time, these chartered commercial banks can also elect members onto the board of the Federal Reserve District Banks. And now with this setup, what we can see is clearly the commercial banks can influence the Federal District Reserve Banks. So the Federal Reserve is not 100% independent of the influence of the commercial banks. And now, this is the problem. When the players, they can elect a referee to oversee the game they play, they may actually influence the decision of the referee. So the central bank in the US is not independent of the private sector influence. The most famous committee is the Federal Open Market Committee. Which sets the bank rates in the US. And everyone pay attention, because if the US interest rate changes, the foreign exchange will change. and the supply of US dollars would also change. And don't forget, the US dollar is the most commonly used currency in the world. So, the chairman of the Federal Reserve is actually comes from the 7 governors at the headquarters in Washington. And these 7 governors nominated by the president and confirmed by the Senate. So it has the elected official input because the president elected, the Senate members also elected. So the appointment of these governors would have the elected official input, and they have a term of 14 years. And this is max. Everyone appointed will serve only 1 term, 14 years maximum. And out of the 7 governors, 1 will become the chair of the Federal Reserve. And the chairman serves a 4-year term. And it can repeat and repeat and repeat until it served entire 14 years, the maximum. Then the person had to leave. And now, in the US, the Federal Reserve not go independent, just like Canada, but it is instrument independent. Because the mandate is set, but how we can reach that mandate is up to the government and the Open Market Committee. All right, so let's stop here today. Now, before class today, I just checked the exam